Hello everyone and welcome back to my channel. In today's video, we are diving into the fascinating world of order to cash, a fundamental process for businesses of all sizes, whether you are a small business owner or simply curious about how companies manage their finances, you are in the right place. So, what exactly is the order to cash process? Well, it's the backbone of any business operation, encompassing everything from receiving a customer's order to getting paid. In this video, we'll break down each step of the order to cash cycle, explore some common challenges businesses face, and discuss best practice for streamlining the process. Understanding the order to cash process is essential for businesses looking to optimize their operations, improve cash flow, and enhance customer satisfaction. Whether you are a business owner, a financial professional, or simply curious about how companies manage their finances, this video will provide valuable insights that you can apply to your own endeavors. So, grab a pen and paper, take some notes, and let's dive into the world of order to cash. And don't forget to subscribe Job Seekers for more videos on relevant topics. Let's get started. The order to cash process, also called O2C or OTC, refers to the entirety of a company's ordering system. It starts the moment a customer places an order and ends when an invoice is paid and settled. It's a set of business processes to manage everything that is time related to some function of marketing, sales, or branding. O2C will define your success as a company and your relationship with customers. Many believe the order to cash cycle time is complete when the customers pay the bills and several important steps occur afterward. Activity data must be recorded throughout the O2C cycle and analyzed to identify opportunities for optimization and improvement. Now let's get started. What is O2C cycle? So there are some steps in O2C cycle. First, order placement and management, credit management, order fulfillment, order shipping, customer billing or invoicing, payment collection, cash application, deductions, and management. So first step is order placement and management. The O2C cycle begins with order management. This usually happens when a customer makes an order. Business that use automation let different departments start their task right away. These departments get notified automatically, which helps in completing order on time. Next is credit management. Credit management refers to the process of overseeing and controlling a company's or individual's credit policies and practices. It involves assessing credit worthiness, extending credit to customers or clients, monitoring credit usage, and ensuring timely payments of debts. Effective credit management is essential for maintaining a healthy cash flow, minimizing bad debts, and maximizing profitability. It encompasses various tasks such as evaluating potential borrowers, setting credit limits, monitoring payment patterns, pursuing overdue payments, and managing relationships with creditors and debtors. Next is order fulfillment. Order fulfillment is the process of completing and delivering customers' order from the point of sale to delivery. It involves a series of steps including receiving orders, processing them, picking items from inventory, packing them securely, and shipping them to the customer's address. Order fulfillment also includes managing returns and exchanges as well as providing customer support throughout the process. In e-commerce, efficient order fulfillment is crucial for customer satisfaction and retention, as well as for maintaining a competitive edge in the market. This process often involves coordination between various departments such as sales, inventory management, logistics, and customer service to ensure orders are fulfilled accurately and on time. Next is order shipping. Order shipping refers to the process of transporting goods from the seller's location to the buyer's specified delivery address. It is a crucial aspect of order fulfillment in e-commerce and retail businesses. The order shipping process typically involves several key steps. First is order processing. This includes verifying the order details, preparing the items for shipment, and generating shipping labels. Next is packaging. Products are carefully packaged to ensure they are protected during transit. Packaging materials may vary depending on the nature of the items being shipped. Third is carrier selection. The seller selects a shipping carrier or courier service based on factors such as cost, speed of delivery, and reliability. Next is labeling. Shipping labels contains information such as recipient's address, tracking number, and shipping method are affixed to the packages. Next is transit. The packages are handed over to the selected carrier for transportation. The courier is responsible for delivering the packages to the designated address within the agreed upon time frame. Next is tracking. Both the seller and the buyer can track the progress of the shipment using tracking numbers provided by the carrier. This allows them to monitor the status of the delivery in real time. Next is delivery. The carrier delivers the packages to the recipient's address. Depending on the shipping method chosen, the recipient may need to sign for the delivery. Next is confirmation. Once the packages are successfully delivered, the seller and the buyer receive confirmation of delivery. So next step of O2C is invoicing. Invoicing is once the order is fulfilled, the company generates an invoice detailing the products or services provided along with the agreed upon prices and payment terms. The invoice is sent to the customer. Invoicing is the process of generating and sending bills or invoices to the customers for products sold or services rendered. It is a crucial part of the business's financial operations as it initiates the payment process and records revenue. Here are the overview of the invoicing process. First, create invoice. The first step is to create an invoice with all the necessary details including the customer's name and contact information, the seller's information, invoice number, invoice date, due date, itemized list of products or services provided, quantities, prices, and any applicable taxes or discounts. Send invoice. Once the invoice is generated, it is sent to the customer through a chosen method such as email or electronic invoice platforms. Some businesses may also provide options for customers to access and view their invoices online. Track invoices. It's essential to track invoices to ensure they are received and processed by the customer. This may involve using software or tools to monitor the status of invoices, such as whether they have been opened, viewed, or paid. Follow up. If the payment is not received by the due date, it's common practice to send reminders or follow up communications to remind customers of outstanding invoices and request prompt payment. This may involve sending automated reminders or making personal contact with the customer. Receive payment. Once the customer submits payment for the invoice, it is recorded in the company's accounting system. Payment methods can vary, including bank transfers, credit card payments, checks, or electronic payment platforms. Record payment. Upon receiving payment, the payment is recorded in the company's accounting record and the corresponding invoice is marked as paid. Reconciliation. Periodically, the company reconciles its accounts receivable with its financial records to ensure that all invoices are accounted for and that payments match invoices accurately. Any discrepancies are investigated and resolved. Next step of O2C is account receivable. Account receivable AR refers to the outstanding payments owed to a business by its customers or clients for goods or services that have been provided on credit. It represents the money that is expected to be received by the company within a specific time frame. Account receivable is considered an asset on the company's balance sheet since it represents the right to receive cash in the future. Here are some breakdown of key aspects related to account receivable. Invoicing. Account receivable typically originates from invoices issued to customers for products sold or services rendered. These invoices outline the details of the transaction, including the amount owed, payment terms, and due date. Credit terms. Businesses often extend credit to customers by offering payment terms such as net 30 days, which means the payment is due within 30 days of the invoice date. Other common terms include net 60 days or net 90 days. Account receivable aging. AR aging is a report that categorizes outstanding invoices by their due dates. It helps businesses track and manage their receivables by identifying overdue payments and taking appropriate actions such as sending reminders or initiating collection effort. Collection effort. Businesses may need to follow up with customers to ensure timely payment of outstanding invoices. This may involve sending reminders, making phone calls, or even enlisting the help of collection agencies for overdue accounts. Bad debt provision. Sometimes business may encounter customers who are unable or unwilling to pay their outstanding invoices. In such cases, a provision for bad debts may be made to account for the expected losses. Cash flow management. Efficient management of accounts receivable is essential for maintaining healthy cash flow. Businesses need to balance extending credit to customers with ensuring timely collection of payments to meet their own financial obligations. Reconciliation. Periodically, business reconcile their account receivable balances with their financial records to ensure accuracy. This involves matching payments received with outstanding invoices and resolving any discrepancies. Next step of O2C is payment processing. Payment processing refers to the step involved in accepting and managing payments from customers for goods or services provided by the business. It encompasses various stages from capturing payment information to deposit funds into the merchant's account. The customer submits payment for the invoice through various methods such as wire transfer, credit card, or check. The company processes the payment and updates its financial records accordingly. Here's an overview of the payment processing process. Payment authorization. When a customer initiates a payment, whether in person, online, or via mobile device, the payment information such as credit card detail is transmitted to the payment processor for authorization. The processor verifies the validity of the payment method and checks if the customer has sufficient funds or credit limit to cover the transaction. Transaction routing. After authorization, the payment processor routes the transaction data to the appropriate financial networks such as Visa, MasterCard, or American Express, depending on the type of payment card used by the customer. Clearing. During the clearing process, the transaction details are exchanged between the merchant's bank's acquiring bank and the customer's bank issuing bank through the respective payment networks. This step confirms the transaction and initiates the transfer of funds from the customer's account to the merchant's account. Settlement. Settlement involves the actual transfer of funds between the banks involved in the transaction. Typically, funds are deposited into the merchant's bank account within a few business days, although settlement times can vary depending on the payment method and processing agreements. Payment gateway integration. In e-commerce and online transactions, a payment gateway serves as the interface between the merchant's website or point of sale system and the payment processor. It securely captures payment information, encrypts it for transmission, and facilitates communication between the merchant, customer, and payment processor. Security and compliance. Payment processing system must adhere to strict security standards such as PCI DSS, Payment Card Industry Data Security Standard, to protect sensitive payment data from unauthorized access or fraud. Compliance with these standards helps ensure the security and integrity of the payment ecosystem. Reporting and reconciliation. Payment processor provide merchants with reporting tools and reconciliation services to track transaction activity, monitor payment trends, and reconcile accounts. These tools help business manage their finances, detect discrepancies, and analyze sales performance. Next step of O2C is cash application. Cash application is the process of reconcile incoming payments received from customers with their corresponding invoices or account receivable records in the company's accounting system. It involves matching payments received to the invoices or transactions they are intended to cover and updating the company's financial records accordingly. Once the payment is received, the company applies it to the corresponding customer accounts and marks the invoice as paid. Here's an overview of the cash application process. Receive payments. When customers make payments for invoices or outstanding balances, the payments are received by the company through various channels such as checks, wire transfer, credit cards, payment, electronic fund transfer, or cash deposits. Payment identification. The first step in cash application is to identify and categorize the received payments. This involves recording relevant details such as the payment amount, payment method, date of receipt, and any accompanying reference information such as invoice numbers, customer IDs. Matching payment are matched to the corresponding invoices or transactions they are intended to cover. This typically involves comparing payment details such as amount and reference information with open invoices or account receivable records in the company's accounting or billing system. Allocation. Once a payment is matched to an invoice or transaction, the payment amount is allocated to clear the outstanding balance associated with that invoice or transaction. If the company covers multiple invoices or transactions, the allocation is disturbed accordingly. Update records. The company's financial records are updated to reflect the application of payments. This includes marking invoices as paid, updating account receivable balances, and recording the payment details in the accounting system. Reconciliation. Periodically, the company reconciles its cash application record with its bank statements to ensure accuracy and completeness. This involves verifying that all payments received and applied match the corresponding bank deposits and identifying any discrepancies that require further investigation. Next step of O2C is cash reconciliation. Cash reconciliation is the process of comparing the balances of the company's cash accounts, such as bank accounts and petty cash, with the corresponding records in the company's financial records. The goal of cash reconciliation is to ensure that the company's records accurately reflect the actual cash balances and to identify and resolve any discrepancies that may exist between the two. Finally, the company reconciles its accounts to ensure that all payments have been properly recorded and accounted for. Any discrepancies are investigated and resolved. Next step of O2C is deductions management. Deductions management typically refers to the process of tracking, analyzing, and managing deductions taken by customers from invoices in business-to-business transactions. Deductions can occur for various reasons, including pricing discrepancies, quality issues, shipping errors, promotional allowances, or compliance violation. Effective deduction management is crucial for businesses to minimize revenue leakage, improve cash flow, and maintain positive relationship with customers. Here's an overview of the deductions management process. Capture deduction. The first step is to capture and document all deductions taken by the customers from invoices. This involves closely monitoring incoming payments and identifying deductions related to pricing, quantity, shortage, returns, or other issues. Categorization. Deductions are captured based on the reason for the deductions, such as pricing discrepancies, promotional allowances, compliance fines, or chargebacks. Categorization helps business understand that root cause of deductions and identify trends or patterns. Investigation. Each deduction is investigated to determine its validity and accuracy. This may involve reviewing supporting documentation such as invoices, purchase order, shipping records, and communication with customers or internal departments. Resolution. Once the validity of deduction is determined, business take appropriate action to resolve them. This may involve issuing credits or refunds, disputing invalid deductions with customers, negotiating settlements, or implementing process improvements to prevent future deductions. Tracking and reporting. Deductions management system track and report on deduction activity, including the volume, value, reasons, and resolution status of deduction. This data helps business identify trends, measure performance, and prioritize deductions for resolution. Process improvement. Businesses continuously evaluate and improve their deductions management process to reduce the frequency and impact of deductions. This may involve implementing automation, standardizing procedures, enhancing communication with customers, or providing training to employees involved in deductions management. Collaboration. Effective deductions management often requires collaboration between various departments within the organization, including finances, sales, customer service, and logistics. Clear communication and collaboration help streamline the deductions management process and facilitate timely resolution. Thank you for watching this video. If you like this video, then please hit on like button and share this video with your friends. Also press the bell icon so you get notified for all the videos and subscribe our channel for more relevant videos.